Hello and welcome to Ask ByteTree. So I remembered the name of the show, which is great. And my name is Charlie Morris, and with me is Tom Salter, one of our favorite analysts at ByteTree. Hello, Tom. How are you doing today?
Hi, Charlie. Well remembered on the name.
So as always, we're going to talk about my piece. We'll kick off with that, and we've got a few other things to talk about today, and that's MicroStrategy. So MicroStrategy basically trades as at today, 106% premium. And so you've got a company that owns 106,000 Bitcoin, and you've got a legacy software business at the stock market for several years, valued at $1 billion. So, keep it at that. And then you've got some debt now, 2.2 billion of debt. And you put all those together, and the market cap of MicroStrategy is 106% bigger than the net assets, which is really quite something, isn't it?
Well, it seems that MicroStrategy is sort of, as you alluded to, broken away from its actual business, and seems to be more of a sort of easy way to get exposure to Bitcoin now.
Yes. So the bottom line is the trading volumes of MicroStrategy are vast. It's now $450 million every day, and I think that what was remarkable, that's higher than Grayscale, which is about 4 times larger, and about five times larger in terms of Bitcoin held. So it's really remarkable. But I guess MicroStrategy trades on the main market, and that really helps. So it's there, it's on the proper stock exchange, and so everyone's got access to it. Whereas Grayscale's off to the side somewhat. So that is a difference. But because if you had an ETF that we had no debt, then you had $100 worth of Bitcoin price doubles, it's worth $200. That's it. But when you've got leverage, the relationship's not 1 for 1, but it's 1.4 for 1. And so if the price of Bitcoin doubles, then you make not twice your money, but 2.8 times the money. You know what I mean? Yeah. and so, which is great. But when you're trading at 106% premium to NAV, you kind of already had that future growth, and that's the thing. I'm not sure if people understand this, or there's just a GameStop thing going on. People have held the stock short, but it is crazy.
Yeah, just on that point, I think something we need to hammer home is this 1.4 times leverage, and that's just absolutely incredible. And anyone in the crypto space realizes that leverage isn't always the best thing to have on a crypto asset. So with that being said, what's the risk here? What Bitcoin's price fluctuates, MicroStrategy stock seems to be fluctuating more than the price of Bitcoin. So, when do we get in the danger zone?
Well, there's two things that could go wrong. The first is that Bitcoin stays where it is, or it goes up, and MicroStrategy stock goes down because the premium evaporates. That's exactly what happened to the Grayscale premium earlier this year. It used to be really high. And that went negative. So Bitcoin could go up and MicroStrategy could go down. But the real danger is that if Bitcoin goes down a lot, because MicroStrategy's equity is basically wiped out at $12,000 Bitcoin. Now, I don't think our central view is $12,000 Bitcoin. That seems a bit bearish these days. But I suppose if we had a 2008 type crisis, absolutely, that's the sort of thing that you'd see for a short period of time. And so that would make MicroStrategy's stock worthless. And so, it would go down 99.9%. So that's the risk. Now, cleverly, he's managed to put his debt. He's got 3 bonds, and they're all after 2025, so the next halving. So, he clearly believes that halving is going to provide a boost to the price, and so that will never happen.
Yeah, just to touch on that halving part, and actually we'll go ask you more in detail about the debt and the capital structure, Charlie. But just to touch on that, our experience, although we haven't got a big data set, is that a halving, we'd hope the market was efficient enough to maybe price in a halving and not catch everyone at surprise when it happens. So is Michael Saylor playing with fire a bit here?
Well, I mean, on the halving question, does halving increase the price of Bitcoin? Now, most people think it does. I mean, the vast majority of Bitcoiners are absolutely certain that it's a really good thing. And we wouldn't disagree. It's certainly not a bad thing. It's got to be positive rather than negative. But how positive is it? And you've got a sample of 3 halvings, so which means we have no idea. And all the bear markets have just so happened to come in years that were also bad macro years for investments generally. So there is a degree of coincidence in the timing of halvings and the risk-on nature of market macro when the Feds hit the pedal, with the good times, like it did late last year. And so Bitcoin did not respond to in the aftermath of halving last time, nor did it particularly the time before. It took some time before it started going up. So there's no immediate link. But the real problem is that any half efficient market would price that in. So let's say halving causes the price of Bitcoin to double in the future. So if you know that Bitcoin's going to be 8 times higher in 12 years time after 3 halvings, because it sort of doubles each time, let's say, then you discount that back, and any rational investor will say, oh, great. And therefore you'd pay a higher price for Bitcoin today because halving is going to have a positive impact on price. And so I think that, if you look at things really simply, of course, halving's amazing, and it guarantees double your money each time. But if you think it through, and the nature of markets and the fact that everyone knows about halving, then it can't be as easy as that. There must be a bit more to it. But nevertheless, he's put the debt rescheduling in the right place, after halving rather than before.
Yeah, well, let's hope that no one realizes it's happening. We all double our money. But just touching on debt a bit more. Every time I look at MicroStrategy news, issuing bonds and debt, and now it seems equity to buy Bitcoin. And I think for the less versed person, what does that actually mean? And from a legal and compliance perspective, has this ever been done before? It seems pretty out there, but it seems that no one's really fighting it. They're sort of letting it happen, and they want it to happen. Yeah,
well, this premium is really big, and obviously for the existing shareholders, it's great. The share price go up. That's what else matters. But it is what can happen later, and also the sensitivity that it means that you won't be 1.4 times leverage in the future. You might be for a bit longer, but you won't be for long, because ultimately it must unfurl. And I suppose that Saylor himself is taking advantage of this premium. I mean, he's quite cunning. So, he's always looking at his capital structure, whether he can issue a convertible bond or most recently a junk bond, and paying quite a high coupon. And now he's saying, well, actually, my stock's at a premium to the net asset value. It's so big, I could just issue stock. So he'll end up owning less of the company, but who cares? Because it's accretive. So the shares will be worth, the book value of the shares will have more Bitcoin per share, because he's issuing the stock at 200, $100 a stock at 200, and able to buy 200's worth of Bitcoin. And so everyone will have more Bitcoin per share, which is, a win for MicroStrategy shareholders, even though they will own a lesser piece of the overall pie. But who cares? They're making money. But you've got to feel sorry for the suckers buying the stock. I mean, that's the weird bit to me. Why do people do it? Is it lack of information, or is it just a sort of GameStop thing? Where everyone's just sort of squeezing shorts out and stuff like that.
Yeah, I think another part of that is, obviously we're both in the space. So for us, simply buying Bitcoin is very easy. I think Michael Saylor is fantastic at coming across as sort of the guardian angel of crypto, and no one's really shouting at him on crypto Twitter like Elon Musk. But I think people think that they can sort of buy a MicroStrategy, gain some exposure to Bitcoin. I don't think they quite understand that they're gaining sort of a 1.4 times leverage position. But I think they almost trust in Michael Saylor, if you like. And I think that's where they want their exposure. I think they see him as a fund manager at the end of the day, sort of trading Bitcoin intraday and looking after their money. But who knows? Hopefully he carries on a good path.
But he is a legendary salesman. I mean, he's been amazing for this space. Let's not mistake that. I wish I had 1/10 of his sales capacity to get the crowd excited. It's unbelievable. I mean, some of the stuff he says is, I think, huge exaggeration. The store of monetary energy and the sort of guaranteed nature of in the math You know, is that true? I don't think that's true. I think that the future's up for grabs. I don't think that it's been written. And but you know, he's got the most liquid trading vehicle now for Bitcoin in the United States when an ETF isn't allowed. So I guess the other great risk would be if the SEC did allow an ETF, then that would evaporate the premium in a heartbeat, I would think. So, but we'll move on. We'll talk about token takeaway. So what is token takeaway, Tom? And you write it. So what is it?
Well, we've had quite a lot of fun. Tom's token takeaway on a Thursday, and essentially it's our sort of homage to the tokens out there, and sort of I think we're in a part in maturity of the space where tokens deserve a bit more coverage, and obviously from an investment side, quite a lot of tokens were good, ICOs not so good, but we'll leave those behind. And essentially every Thursday I look into a token that's come into our view through a ByteTree model, and then I give our premium subscribers an actual insight backed up with actual ByteTree data, and sort of show them how the token works, and tell them what we think of it.
Yeah, so in essence, basically, there's a bit of number crunching in the background, and that pops out some tokens that we think are superior and have the ability to do well, and then you're doing a qualitative overview of you know the one we want to talk about, and hopefully what's going to happen is we're going to lock on to half a dozen to a dozen of these things that we think are, you know, have superior quality to most tokens, and sort of get behind them and keep people informed.
Yeah, 100%, 100%. We're trying to pick the winners really in a sea of you know, there'll be 10,000 tokens in no time, and I just think we need some visibility on those and help our subscribers really, you know, learn about them in a proper way.
And then last night, I'm not sure how many tokens the Federal Reserve are concerned about and are watching, but they made their statement, their June statement, and essentially they, you know, what it boiled down to is they said they'd raise interest rates in 2023. And, you know, our friends Gold and Bitcoin presumably don't like rising interest rates. I mean, the last time interest rates were rising was what, 2018. It was through most of that year, and Bitcoin wasn't having much fun during that time. So I don't think that our hard asset space is going to respond too well to that. But I suppose it's not going to happen. I mean, that's the real thought here, is that the impact on financial markets will be so devastating that just the sort of hint of it is bad news. But I just find it very, very unlikely that they'll actually get there, because the economy is either going to overheat and we're going to have an inflation spike, and which is good for gold and Bitcoin, and they're behind the curve and they will have to raise hike rates, or it will just slump again like it's been doing ever since 2008, and they won't hike rates because they realize they'll just see asset markets implode, which will cause even more problems for them. But nevertheless, you know, in the last 24 hours, we've seen the price of gold sell off. Bitcoin actually a bit more resilient because the bond yield went up, which, you know, we would deem as risk on environment. So that's, you know, it wasn't too bad for stocks, wasn't too bad for Bitcoin. But dollar up, you know, we talk about Bitcoin in dollars, and so you get more Bitcoins per dollar if the dollar goes down, and so dollar goes up, you get fewer Bitcoins per dollar. Just to touch on that, there was some news the other day. Paul Tudor Jones, he was talking about how he'd allocate 5% to Bitcoin because his worries about inflation. But from what I see, although I have quite a bearish view on what the Fed said yesterday, it seems that it's not as, some people think it's not as bad as we previously thought it would be. What are your thoughts on that, Johnny? Well, the inflation has 2 points to it. Part of it's the so-called base effect, where, you know, the year-on-year change. When you start with negative oil price in April last year and compare April to April, May to May, you get these huge numbers. Now, when that sorts itself out and the oil prices become a bit more normal to the news prices, then your year-on-year change it comes down a lot. The long-term expectations are, you know, we did see a print of 5% inflation, but but actually the long-term expectations are all sort of 2.5 to 3 territory. So the bond market saying, looking through that and say, well, it's all going to cool off, and what you've had is a bottleneck. When you sort of unlock everyone from being locked up in their houses for God knows how long, then guess what? You get a bit of a spending boom, but that's not permanent, and it's going to reverse. So that's what they see. So, but we aren't really sure what the long-term implications are, because things like in the inflation data, a big weight in the US is owner's equivalent rent, which is really low, and so that's not even reflected yet, and that's going to start going up in quite a big way. And there'll be a few other things like is there a long-term impact to any of these supply chains and so forth. Now, if as post 1990 globalization trends continue to rise, then all will be well and deflation will prevail. But if something changes, prepare to be shocked. I think that's the real point here. There's just a lot of funny money out there, and it just seems that the only reason the world economy seems to grow is because they print money. I mean, the relationship between the growth in M2 over a decade and nominal GDP growth is pretty strong. And I mean, it always has been, but there's been a lot of M2 growth, which is why you've had lots of nominal GDP growth. And nominal GDP is inflation and real, and there seems to be less and less real each time, and more of the other one. But of course, real GDP growth is structurally much lower in the last decade than in previous decades, and that trend seems to forever slow. So lots of unknowns, which is probably one of the reasons people like alternative assets so much.
Oh, fantastic. And we've got a couple of questions come in. So obviously, this is my flatmate, Harry Potter. And he's away at the moment, but he asks, good afternoon, do you think the DeFi market can boom without BTC following suit? Obviously, I have quite a few thoughts on this. No, I don't think so. I don't think at the moment that it can. I think possibly in the future we see a slight decoupling, but I generally see Bitcoin as a reserve asset for the space. And what we've been seeing is wrap Bitcoin or Bitcoin alternatives, as they're called, essentially versions of Bitcoin which can be used on Ethereum in DeFi. And we've been seeing the amount on Ethereum grow at a really stable pace over the last sort of 6 months. And that really indicates to me that people are looking to make a yield on their Bitcoin. And I think you can't underestimate the size of that market alone, and actually how much that means to DeFi, which comparatively to Bitcoin in itself is very small. But in the future, who knows? But at the moment, no, I can't see it following suit.
Thanks, Tom. Well, next question. ByteTree terminal indicators are red, i.e. velocity is 372%. Is it 372? I thought it was 272. And does this indicate a new fall in BTCs on the cards? Well, velocity on its own has been a so-so indicator. It's structurally falling over the years as more and more Bitcoin basically gets hodled and locked up in funds and that sort of thing. And so fewer coins seem to be spinning around the network, and more seem to be sitting still. That's a structural theme that you pick up on the long-term data. But essentially, a busy network is a valuable network, and a quiet network is less valuable. So, a falling velocity is telling you that things are quietening down. So you can't expect a boom when all the on-chain activity is soft. What normally happens is that a pickup in on-chain activity coincides with a pickup of the price. And I would think, judging by the testing that we've done, the on-chain data leads price. If it didn't, it wouldn't have such a successful track record compared to price, which naturally follows into the next question on transaction value. Why do you feel it's a leading indicator? When I look at the last 12 weeks, it looks like it's following price. Well, I think that this is a 1 week smoothing. So we've got every single block, 144 blocks a day. Is that correct? I'm sure it's correct. 144 blocks a day. Each one, as a block comes, one block comes out, the next one goes in, and we smooth that 7 days. And because of the weekend bias, where blockchain data, blockchain activity collapses at weekends by about a third, the 7 day smoothing gives you the most accurate, timely signal of what you can get. And certainly if you look at that same indicator over a year, you see it's a leading indicator. It led the market in Q4 when it really mattered, and so forth. I think that in the sort of Musk era, our data hasn't been quite as strong as it had been the rest of the time, when literally speculation just took over, and off-chain volumes relative to on-chain volumes were probably at record levels, late 17 type levels. So there are times when it can be a bit lagging, but I think structurally the concept that the price of Bitcoin must be anchored to the level of activity is something that I can't see why that would ever change. If no one uses Bitcoin, I can't see how it's valuable. Just because everyone buys it and just leaves it there and doesn't use it, or there's no liquidity in the system, that wouldn't be valuable. What's very valuable is having a lot of people owning it and having a lot of liquidity in the system. Those things really help support price. And the more use cases, the more different actors using it for different reasons, the more robust the whole market becomes, and the less volatile it becomes. So it's all of those things coming together. I very much don't believe that Bitcoin goes up to $1 million just because everyone buys it. I think that you've got to buy it, and it's got to have a purpose as well. That purpose can be collateral. There's nothing wrong with that. It doesn't have to be something you can eat or charge a car with. But there's got to be a real element to this space, or else it's just going to not stand the test of time. Tom, do you agree?
Well, I totally agree with that, and I think in the end we need to see on-chain pick up to feel comfortable in this in this market, really. I think certainly echoing the Elon Musk point. We do have mania periods, and that was certainly one of them. And then we're coming back now, and people are probably a bit wary about using the network. Maybe they've sort of a bit scarred from Elon Musk, maybe. But I think that like I said, we need to see transaction value increase a lot, velocity, and a number of different metrics need to turn.
They just need to pick up. Now, a dog has just disturbed me, which is go away. So we'll move on to mining difficulty, because something has happened recently. We've had 2 drops in difficulty, one at the end of May, one in the middle of June. So a lot of people still think this is a bull market, a dip in a bull market. Well, you wouldn't normally see drops in difficulty and 2 consecutive ones. And we're also seeing the average block interval still at just under 700 seconds, 690 seconds. And of course, it's supposed to be 10 minutes, which is 600 seconds. And so when the blockchain is slowing down, that means it's too hard to mine. So we're going to see another drop in difficulty, and so it's going to become quite significant. It's already gone down from 25,000 billion gazillion, whatever they are, to 20,000, and it will go down again. So that's good for the ESG, I suppose, isn't it? It's a lot less energy to consume.
Yeah, that's a brilliant point. I was just going to say that, well, maybe the Chinese mining sort of disaster, if you will, actually had an effect. China constantly banning Bitcoin and then unbanning it maybe didn't have so much an effect, but I think actually they've really hit the nail on the head with the mining side. And I don't think that's as bearish as it sounds either. I think in the long term, having a wider spread of mining power, and also, as Charlie said, the ESG side of it, I think that's probably good in the long term. But I think we're seeing it in the difficulty, and listeners should look at that metric really to see what we're talking about.
And of course, when it's easier to mine Bitcoin, and the chain speeds up and all the rest of it, fees have come down. The average transaction fees, 90% down from early May, and yet we haven't seen a pickup in transactions. So you'd expect that to come. I'm expecting to see more transactions come through as it gets cheaper to do so, and that can even happen in a soft price environment, as other actors come in and use the space. But the other thing we just want to talk about is the miners, the MRI, miners rolling inventory, which what we noticed was a couple of weeks ago, there was a spike in first spend. So as the price of Bitcoin was rallying from 30,000 to 40,000, the miners who had been stocking up on Bitcoin sold into the higher price at 40k, and then we had a couple of days of softness, following the Fed, a day of softness following the Fed, and they just held right back. And so once again, the miners have slowed down their selling because they don't want to damage the market. So this reiterates this idea that when the miners are selling hard into the market, it's telling you the market's really strong, and so that's positive for price. And people sort of say, well, surely the miners dumping Bitcoin is bad. Well, yes, I mean that can be bad. It happened in late 2018 when Bitcoin went from 6,000 to 3,000. There was some miner dumping at the same time, which was pretty unhelpful. But generally it works the other way because the miners are good traders. Simple as that, really.
Yeah, and I think MRI is such a fantastic metric. And I think from my own personal experience as a miner, and touching on what Charlie said about 6,000 to 3,000 was certainly a part of that. And I think miners are really in tune with the market, and following their movements can give you really good insight into really their sentiment. Obviously, there's other factors, and they did sell into what they perceived as a strong price, and stopped selling when they didn't think the price was good enough. I think that shows a good sentiment about where we are in the market.
Now, Tom, we're going to finish off shortly, but I'm going to let you talk about Ethereum Layer 2 solutions, which you've got a piece out today. It was out today, wasn't it?
I think it will be out in the next couple of days. My takeaway will be out.
We'll do read this. It's quite important stuff. It's about developments, the efficiency and the design of the Ethereum blockchain and so forth. So Tom, take it away.
Thank you, Charlie. Actually, it's probably quite a good link on from what we were saying about what we're seeing Bitcoin's on-chain data, how there's not much demand for block space, the fees are dropping, and that's generally quite a bearish signal. And actually, that's what we're seeing with Ethereum currently, but not a couple of months ago, or even probably a month ago. The gas fees at the moment are around 10 times less for a standard transaction. And just to get, if we go back, when layer 2 is really what we needed, Ethereum's quite often criticized for its inability to house a lot of transactions, and actually the cost of those transactions and the speed being so slow. And people have often said, well, how can you house financial innovation in the crypto space when you can't deal with the transactions? So this is where layer 2 comes in, and it's more of a, I wouldn't say a short-term solution, but it's quicker. And in my article, we talk about around 3 different ways that people are trying to scale Ethereum through a variety of things called roll-ups, and also there's ZK roll-ups with zero knowledge, and we won't get too technical on the call, otherwise we'll be here a while. But these solutions, from a high-level view, are exceptionally good at taking the strain off the main chain. Essentially what they do is they use smart contracts which are harbored on the main chain, but they take away the computational power or completely eliminate it and settle transactions off chain and then broadcast them back. And that basically, in some cases like optimism, can increase your throughput by around 50 times. And that's fantastic for Ethereum and exactly what it needs, really.
Tom, the bottom line here is that every problem that this space has ever faced has been solved.
Yeah.
When everyone slates the Bitcoin blockchain for not, being efficient enough or not being able to handle enough transaction or not being able to take over the world economy, they're missing the point. It's a movement, and all these things that are kind of obvious are being worked on and will eventually be overcome. So that keeps us excited. And that piece you just written is in the free section of the website, not in premium, isn't it?
Yes, so purely educational.
The token takeaways in the premium, isn't it?
Spot on.
Too good for free. Too good for free. Thank you very much for listening, and we'll see you soon.
Thank you, everyone.